any of us could join a webinar and it'd be for some, like, let's say, apartment complex syndication. And it'd be, hey, we're raising 50 grand per unit or whatever it is, and put $50,000 in, and all of a sudden you're into syndication, right? Any of us could join one of those things. There are definitely groups that are popping up that are trying to do that in a wide frame inside the digital space. I've invested in some of those things. I try to tell everybody, I come from all of this from a place of curiosity. And if I see my clients doing it, I try to put my money where my mouth is and also go into some of these things just to see if what people are saying is true in a lot of these types of things. So I've invested in syndications and real estate and all those types of things. I've gone into a little bit of alternative investing and stuff like that. But talk to me about, if somebody gets marketed a thing, how likely is that thing to be a good investment? Like in terms of these alternative investments. So if you see an ad come up on your Facebook for, hey, join this webinar, and it's an ad, like a pay-per-click ad that's on a thing that's trying to take you down a funnel to invest in a thing, what do you think the percentage chances are of that thing being a good investment?
What do you define as good? Being exactly what they project, or just making money versus losing money?
There's a few things that I've seen come up on my end, and I recognize them as sales funnels because I'm super curious about internet marketing and all the things that go along with that. And a lot of them will come off in terms of my world of being like tax strategies. Like they'll be like, hey, there's this cool tax strategy that you can do. And, hey, high net worth person, go onto this webinar. We'll teach you how to save taxes like the rich or something like that. And it's actually a downstream funnel to an investment of some kind, of some type of a thing that they're saying is going to be a thing that's hidden. If you go through their webinar, you're basically inside of their funnel at that point. That's one thing that I see. The other thing is just, I'll see someone saying, hey, we're raising money for this investment opportunity, and we're literally advertising to dentists on this thing. So I guess the first is it what they say it's going to be? The second is in terms of the financial viability of that investment. Is that good? So I guess defining good is it going to give you what they say that it's going to give you, type of a thing?
I would say it's super rare for those things to actually do everything they say they're going to do. If I had to put a percent on it, it's probably close to single digits, definitely under 20%. Like I said, there's a gradient scale there on if it did something positive, but wasn't as good as the opportunity cost of having done something else, public markets or a different opportunity or whatever. I would say it's really rare for those things to actually 100% do exactly what they project to do. That said, they could also outperform that. So I don't want to totally crap on those things. Like I assume a lot of them are well-intentioned, are trying to do the right thing. But like I said earlier, if they haven't considered everything in the market, haven't experienced ups and downs, maybe aren't diversified themselves, if you will, it's kind of a weird deal where they're usually specific on what they're doing, but maybe that's to their own detriment. Like maybe they think that they know Dallas suburbs really well, and that's what they do. But if the Dallas market somehow loses a bunch of business, a bunch of opportunity, and those kind of sub-markets, those secondary and tertiary markets around Dallas suffer because of it, all their eggs are in that basket. So sometimes having somebody who does a similar thing in secondary markets, but in a dozen or 15 different cities where the concept is the same, but now they've transferred it to Jacksonville and Nashville and whatever. And now they do the same thing in similar places, but it's not literally tied to all one market. Those are the things that I look for when I'm deciding to partner with somebody or give them my money, is what's my kind of concentrated risk here with what they're doing. And so I think that they can do some level of what they say they're going to do. It might not be 100%, but some of the things they can't see or don't want to see, or because of the way they've set up their business or the scale they're at, hasn't allowed them to get bigger and broader and diversify even kind of within their own little niche that they're doing. So that's some of the stuff that I try to avoid myself.
I always try to think of like, where's the edge? Where's the competitive advantage, right? And if this group of operators has a competitive advantage, then why are they needing my funds, right? And I don't want to create like a us versus them mentality, like put a tinfoil hat on and be like, yeah, the Illuminati controls everything. But at the same time, we have to be honest in saying that if the competitive edge was significant enough, they could likely go to a family office and get all these funds from a family office from someone who's got $1 billion and just wants a place to put $100 million or something like that. That part to me is always the question mark when I see those ads come up, is why are they raising funds from the public? If it was such a good opportunity, they could just go to a family office, because there's tons of those now.
So two things I want to say to that. It's one of those odd issues with what we're doing here with Legacy Point and the people that we partnered with to offer these opportunities where, like you said, they don't need a lot of capital sometimes. They do have institutional partners on the other side, like family offices and large, well-capitalized individuals who often gobble up all the allocation there. And they might open the doors to this opportunity, and in a month it's gone because it was a good offering or a good opportunity, or the other person got liquid on the last thing they did and now they just dumped it on the next thing that they're doing here. That is a good point, and that happens in the space that I'm in because these are good opportunities. They don't often have to go advertise and raise money. They just have the same recurring partners. And so for us to be able to get that opportunity, we never pressure anybody to act quickly, but sometimes these things go quickly, and that's just the nature of the beast. As far as if they're good enough, they don't have to advertise, and they've kind of created their own behind the scenes partnerships. And so I feel like I've gotten exposure to things that I wouldn't have otherwise, but you sometimes do have to be ready for that opportunity because they can go quickly. I've seen that happen more than once where it's a dentist, they're busy, they have a meeting, they learn about the thing, they have a follow-up maybe 2 or 3 weeks later, and then they're still deciding what they want to do. And next thing you know, it's gone. And that's fine. Like the people that are brokering the thing or offering the thing, their whole goal is just to raise capital. And we want to offer it to dentists to be able to be involved and engaged and take advantage of these opportunities. But ultimately, that's not what the other people on the other end of this care about. On the other side of this, fortunately, with the people I've partnered with, they've got close to triple digits as far as offerings at any given time that they've passed through their ecosystem. So feeling like this deal is the only time I'm ever going to see anything good is also not true. What we're showing here and what we're offering here is not a pressure thing. It's not this is only going to happen once in a decade and take it or leave it. These are things that conceptually are going to be available again. It might not be right now when you've already had the conversation, but the strategies and the opportunities, they come and go. And, we just want people to learn about what's out there and what they could be doing and the way the taxes work and all that kind of stuff. And then I kind of step out of the way and let people do what they want. If they want to actually employ and deploy capital to those ends, that's great. But I just want to be kind of a educator and connector.
And we skipped over this, and I think it's a cool story. So why don't you touch on this? Because you mentioned taxes. How did you start this journey of going down this alternative investment path? What led you to going into this world?
It was two things. I already touched on the one with just trying to get out of my own way from a time scaling perspective with private market things. But the other one was with Modento. When I sold that business back in 2021 to Dental Intel, there was a large capital gain, and I was learning about the details of selling a business and what that means and taxes and all that kind of stuff. And it's a whole different bucket of money at that point from your income that you've been getting from your business the whole time, whether it's your dental practice or rental house or even your private residence is subject to capital gains when you sell it. You can do things to both kick that tax bucket down the road, and if you invest in the right thing, have all of that growth and gain not be taxed along the way. I was learning about those things. Those are called opportunity zones. And just a quick 60-second rundown of what an opportunity zone is. Back in 2017 with the Tax Cuts and Jobs Act, they basically drew lines in every area of major cities, especially where they wanted to drive business and drive commerce. And so they said, these are the areas that need a little help. And so for building something here, a business or whatever, we're going to incentivize that. And the operators get some sort of incentive, but the investors also get incentive where your dollars that would have been taxed at capital gains, if you put it into that thing, your tax dollars are not due from your original sale until the tax year 2026. Payable in 2027. So we're obviously getting closer to that. So this becomes less advantageous the closer we get to that. But there's talks about kicking that can even further down the road because they see that expiring and the amount of commerce and things that it's brought to these areas. They want to keep encouraging that. And I guess kind of even zooming a little bit further out, that's kind of all the tax savings and mitigation is really the government said, we want more of this thing. And for doing that thing, we'd like to let you keep more of your money. So whether it's oil and gas or these opportunity zones, that's all it is the government saying, hey, we're going to let you do more with your money if you do the thing that we're trying to make happen. Instead of us funding it, we're going to let individuals fund it. And for doing so, we're going to give you some tax advantages for doing it. So back in 2021, sold Modento, looking for a solution to maybe pay less or close to little or no tax as I can. We were still pretty close to where the lines were drawn as far as time. We're 4 years removed from them drawing those lines. And so I didn't see a lot of great opportunities. They still at that time were mostly not good areas. To your earlier point, maybe saving 30 cents on the dollar, but losing the whole dollar because I was trying to chase the taxes on it. So in that instance, I actually ate all the taxes. I paid the tax bill. I didn't invest in anything. I didn't find anything that I felt like on its own was a good investment aside from the tax part of it. But I continued to learn. I continued to network, and it led me 3 years later with a majority partnership sale in my dental practice to now understand this better, have found people and opportunities that I felt like aligned as an investment itself. I'll give you a couple for instances. There was one that it was a name brand hotel, 1 block off the Riverwalk in San Antonio. There was a kind of boutique hotel at the south end of the strip in Vegas where they're bringing in a lot of things like the Oakland A's are moving there and a lot of other sports teams have moved to that end of the strip. That's a major reason why that part of town has become what it's becoming, because it's an opportunity zone. And the people don't talk about that, but that's why a lot of commerce has gone to that end of Vegas, is because people have been incentivized to do that for the last half decade. And those are things that I put money into. And those are the types of opportunities that I see in this ecosystem to be able to do things with. Because now, 7 years removed from where those lines were drawn, things kind of naturally, organically happened in those areas. And now either people being kind of the first mover and pioneering, or just kind of migration of the city has made those areas no longer a bad area to put your money into. It's actually a good area, but the line is still the line. And you could benefit from that because of the way the lines were drawn back in 2017. So that's kind of a little bit of my evolution on alternative investing and specifically opportunity zones. And like I said, I foresee and have been told that maybe that 2026 deadline cutoff is going to get moved because so many people have, seen the positive results of this and obviously don't want that tax bill to come due soon, because this last year and a half is going to be pretty much a waste. People aren't going to care about delaying their tax bill by a single year. But I guess the other part of that I mentioned earlier is the money you put into that has to stay in for a decade. But if you do that, if you fulfill that requirement, everything you put in there is tax-free. So I'll give you an example. If I sold a business for $1 million, I would pay roughly $200,000 in taxes, but I could invest the whole $1 million into an opportunity zone. And in 2027, I'll still write that $200,000 check to the IRS, but I'm still in that deal for $1 million. And I'll tell you about that economics of that here in a second. And the whole growth, if that goes 3x in that decade, I get $3 million on the back end in 10 years, and all of that is not taxed. So it's kind of multi-purpose. You get to delay your taxes today, and everything that happens in that opportunity zone investment. And the way these things are usually written is they understand what they're doing. They understand it's an opportunity zone investment. So in the calendar year 2026, they've got some sort of refi, or they stabilize, and they can go from a construction loan to a long-term loan. And part of that is they'll pull out roughly 25% of the capital as cash, make one big distribution, knowing that people are going to have to write that check next year. And so they've already got that built into the economics of the deal, where they're going to pull out the capital to give it back to you. You're still invested entirely into the operation, but you're handed back your money to be able to do the IRS thing that you need to do, and then still stay in the deal for the 10 years.
Yeah. And I love it. I think it's a really cool opportunity. I think the fact that the president that introduced the Tax Cuts and Jobs Act is now going to be the president again definitely lends to the fact that it likely will be extended, but you never really know. But we'll see. It's an interesting way of going about it. You mentioned illiquidity risk, 10-year lockup period. There is a chance you lose money, right? Nothing's a guarantee, even in real estate. And you also take the operator risk, like you said, too. But it's really cool that you've been able to find people that you've been able to help you find the better deals of those, because I hear a lot about Vegas, I hear a lot about Miami, I hear some about San Antonio. In terms of taxes, yes, put $1 million in, pay $200,000 in taxes, get $3 million out, pay no more taxes is a pretty compelling thing to do. I do just want to give a word of caution to that person that's out there that's like me. It's like, oh, this is a really good idea. I should all in this. Like, that $1 million probably shouldn't be 90% of your net worth. If you sold your practice for $1 million, you probably shouldn't put $1 million into something like this. And again, we're not financial advisors. I'm just spitballing here, but I would say 5 to 15% of your net worth probably is substantial still to do those types of things. Depends on your risk appetite too.
And I overly simplified and just stayed in that lane as far as what I was talking about. But yeah, if you sold a business and you needed that liquidity to live on, like we would talk about and teach you about that kind of thing. And that's what the advisors over here would make sure that you kept yourself in a good liquidity position for what you needed from a lifestyle perspective. And even in that example where I said $1 million, that would be for me, assuming you had a $10 million sale and you put 10% of it into one thing. Yeah. Like diversification's key. Don't do any one individual thing. Make sure you stay liquid. All those things are things that we talk about and would teach more about as we're members of the group. But yeah, that was just a real specific example to give an easy number, but definitely keep all those things in mind.
So opportunity zones are awesome for capital gains. Another one that you and I've talked about in the past is oil and gas, intangible drilling costs, working interest, all those types of things. I think those are all valid ones. What we kind of touched over is like the CPA's role in all of these things. I'll tell you that my personal perspective of that is that, hey, since there is so much risk involved in all of this stuff, it's hard for me to say to someone that is netting $700K in a year in terms of a take-home pay from a dental practice, say, hey, you should think about doing oil and gas investing, because my fear is I say that to a dozen people, and those dozen people hear that and they go and they think, okay, I got to go do this because I'm going to save money in taxes. And they just go find the first person that sells these things to them, and they do it in a bad way. They lose money. It's a negative return on them. And they point the finger back at me and say, hey, you told me to go do this and I lost a ton of money on it. Now, I hope you have good malpractice, Jonathan, because you're on the hook now. So you mentioned opportunity zones. I guess you can touch on real quick on oil and gas. You think those are good ones right now? Are there any other really good ones you're seeing right now that you enjoy? And then what do you feel like the CPA's responsibility is in all this?
Those are the major ones that I personally employ or have employed. Like we talked about earlier, there are some kind of other things that people pitch. And like you said, they've got leverage and outsized returns, and those are no longer really allowed. And so we want to really stay right down the middle. We're not trying to hit home runs necessarily. We're trying to hit singles and doubles. It might sound overly simplified to just say do oil and gas, but like you said, there's different opportunities and operators out there. There's even something as simple as saying, are you a wildcatter? Are you just going and poking holes in the ground and speculating and hoping, which could have a super high outsized return because, again, they're not doing studies and research and all that stuff. They're just going and picking a spot and putting a hole in the ground. So their overhead and their cost to get there is lower. So your money in could be more money on the backside, but it could also be zero. And I've seen tons of people that end up with zero on those. Most of the things that I'm investing in are large operations established. They're literally building a well site right next to either their own existing well site or an established well site from somebody else. So it'd be sort of like going and building a new neighborhood. And are you going to go build it 10 miles out of town and hope people come there? And that could be a super home run because you bought the land cheap. Or are you going to build it right next door to another neighborhood that's already doing well? You know the price of the homes. It's already full. There's demand there. So it's kind of the same concept in oil and gas too, where you can see what's there, compare it to what's existing, do comps. And then they have geologists and studies and stuff just to verify. They don't just assume that next door to one that works is another one that works, but that's a good starting place. And then they do their own research and figure out. Anyway, the point of that is it's very rare for you to end up with the dry hole if you are partnering with the right person who's doing it the right way and has all the checks and balances and systems in place to make sure that doesn't happen. That said, you can go find those other people if you want to have that risk and reward in your portfolio and process. They exist. It's just not something that I do personally because, like I said earlier, this isn't my play money. This is still money that matters to me. I've still got young kids and I'm not even 40 years old. So I'm trying to make sure that I make this money last for me. Ultimately, preservation of capital is rule number one. Anyway, yeah, these things have tax benefits. You could probably speak to that a little bit too, but they have very much black and white in the code benefits with spelled out percentages. You get a usually 80 to 85% depreciation working interest benefit in year one. So you put $100,000 in, you could usually take $80,000 to $85,000 off of your year one taxes. And then the other 15 to 20% is over the next few years after that. You do have to have liquidity, which is why I mentioned earlier, these are for people that are probably $500,000 and up, and they've already filled up all those other buckets. And they're really having a kind of first world tax problem at that level. Everything at that last $100,000 is taxed at 32% federally, and then whatever their state is. So they're really getting 40 cents on the dollar of a return in year one because of the tax part of it. And then the investment itself is also usually good if you've got partnered with the right people, usually in the teens, somewhere in the 12 to 18% is what I see for me personally. Obviously that's no promise of anything, but that's what I'm seeing for myself. And some have jumped into the 20s, but just depends on the markets. It depends on, it's a commodity. So there's things that you can't control. You can't control the price of oil, but you can control who you partner with and their history and their success rate and longevity and all that kind of stuff. So those are the things I'm looking for. And that's the types of oil that I'm personally putting my money in.
What about in terms of like the responsibility of the CPA in this? The reason I'm asking this is because there are other CPA firms out there that service the dental industry, and like they build their CPA firms on doing this. And I sometimes have those people that have worked with those people switch over to me. So I'm always kind of caught between this rock and a hard place of like, I can see the benefit of it. But as you mentioned, there's a couple $100,000 of due diligence to do it the right way, which my fear obviously is that some of these other firms may not be doing it the right way. They may have just said, hey, I'm going to go find a person that I can just point my people to instead of having that conversation with the client, like, hey, this is something that could be an idea for you, but it's risky. It feels like what they do is they'll say, hey, come to us. We're going to give you this person. And they've just found another person to be the person that goes and finds the stuff for them. And I have no idea if that's a valid thing or not. So what do you think? Is that what you would expect of a CPA? And again, no wrong answers here.
For me personally, because I'm already the person who's looking for this stuff, I don't personally need that in a CPA. Like I understand enough. And I guess that, a group like mine would maybe be a better offering to somebody like that, where it's truly about education. I do have people who are willing to place you in something if you choose to, but my role and what you're getting from me and my group is just information. And I'm a dentist and I'm speaking their language and living what they're living as far as taxes and ownership and all that kind of stuff. I do see where you're coming from, where there's almost implied liability, even if it's not real, that you sent them to somebody in particular or you suggested a certain strategy, and there might be a dozen different strategies they could have employed, but you suggested one. And so I understand that there's some kind of not risk, but just reputational liability, at least on that stuff, where you don't want to be the guy who connected them with something that didn't work out. So I understand that. I do like when CPAs in general are at least educating on kind of tax brackets. And so one of the things we talk about, I'll just give you kind of our overarching theme. In my experience, that jump from the 24% tax bracket to the 32, that's literally the largest percentage jump that it makes. In 2025, it's 395 married filing jointly. That usually coincides with several things. It coincides with you filled up all those other buckets, so you don't really have anything else you could be doing, unless you get some retirement plans and stuff. You could fund a lot more than that, but all the basic stuff is pretty much taken care of at that point. And your after-tax dollars, you're satisfying your personal needs and even your wants at that point. You got 25 grand coming to you every month after taxes. And so everything above that, I feel like could be tax planned away, but to your point, that doesn't have to be. And some people pay taxes either from a civic duty or risk avoidance or whatever. So like you, I'm a little bit towing the line or unclear on what somebody's role should be there. That's where I'm trying to fill that void as a dentist and just a person who wants to share information and give people opportunities. And whether or not they do anything with it, I don't care, and I don't benefit from that. The only thing I benefit is from a very minimal membership fee in the group just to be around the stuff and hear it. But I don't have any incentivization to have you do anything about it. I think that's the closest to the purest way that I see out there. And there are lots of people that are incentivized in different ways, whether they disclose it or not. And I don't know if any of that's happening with those other places you're talking about, but people want to be helpful. And I understand that that's where you're coming from, is I want to help clients and I want to see them succeed. And I don't want them to give away money they don't have to otherwise. But I also understand the risk and the reputational liability and all that stuff that comes with it. So I feel for you on that for sure. So I don't know if that helped at all.
It definitely does, because I would love to be able to wave a magic wand and say that our firm could go and vet all these operators for people as well and be like, hey, we found this person that can, this really cool oil and gas, and we think you should put $100,000 into oil and gas this year. Go talk to them about it. And then it'd be as easy as that. But to be honest with you, we're so busy taking care of our clients from a compliance standpoint and the other pieces of the planning mechanisms. Like our average tax plan saves our clients somewhere between $60,000 and $70,000 a year across our 400 clients. We're so busy doing all those things. It's hard to go and do those things and then be able to keep up with them. And then all the professional risk comes into play, because at that point, I'm really skirting some lines of ethical dilemmas of am I giving financial advice, even though I'm not a financial advisor, and all these other things that go along with it. So I appreciate your perspective on that. It sounds like what you've become, in a way, like the Papa John's guy that was your guy for a while, for other people for this, in terms of I want to go out there, I want to go find these alternative investments, but I don't have the time or capacity or ability to do it myself. Maybe I can just leverage the time and experience that someone like Deren and their group has to be able to help them better understand it. You're obviously not an operator of these investments, but you've done some of the groundwork and built a community around helping look into these things. Is that a fair way of saying it?
Yeah. And it kind of goes back to my role at Modento too. I wasn't a coder. I didn't know how to build a software, but I knew what a dentist needed it to do and what it needed to look like, because I was the end user. I had a couple good ideas. I knew what I wanted it to do. And then I was just going to filter back and forth between the people who ultimately were doing the thing and the people who wanted to pay for that thing. And so in a similar way here, that's what I'm trying to be for dentists in this regard, is I know what I would want to see for myself. I know what opportunities are out there. I've filtered through a lot of them. I feel like I've partnered with the right people on this side of it to make it happen. And I'm trying to get them to distill it down and deliver it in a way that I hear it in a way that resonates with me so I can give it to other dentists and make it make sense for them. I guess that's melding together the Papa John's thing and the Modento thing. I'm just kind of that filtration between these two different worlds to make it make sense for either side as it passes through.
Well, very cool. Your story is awesome. I appreciate you being so given on this episode. I try to ask the questions that I think that people would also be asking if they were to have you on the phone or something like that. But for the people that didn't get their question asked, how can they connect with you? How can they find out more about Legacy Point Group and what you're doing there and things like that?
I guess I'll zoom out even a little bit further. We didn't talk about this. I have my own podcast where we talk a little bit about this stuff. It's also a little bit about more efficiencies in your dental practice and all that kind of stuff too. But occasionally we'll have on sponsors and we'll talk about oil and gas or whatever. And so that podcast is called Wealth Beyond the White Coat. So you can check us out there. If you want to come specifically to Legacy Point, it's legacypointgroup.com, or you could email me, Deren, Deren, at legacypointgroup.com. I'm happy to answer questions. I'm happy to look at an opportunity as a colleague and one of your cohort. Like I said, I'm not a financial person, but I've got a lot of experience in this. So if you want another set of eyeballs and some documents or whatever, I'm happy to do that. So either one of those ways is great. Reach out to me or check us out online, and I'd love to hear from you.
Yeah, the Wealth Beyond the White Coat. Go check it out. Subscribe. Hit all the buttons you're supposed to get it into your ear pods. Deren, thanks for being in front of the podcast. And I'm sure other things will come up in this space that I'll have questions about. And so we may talk again.
I'll have to get back on and talk crypto in the future.
I know. It's an exciting time. Thanks, Deren.
Thanks for having me.
Thanks for tuning in to the Tooth and Coin podcast. If you found value in today's episode, please share it with a fellow dentist or a practice owner who could benefit. Your word of mouth helps us spread financial wisdom throughout the dental community. So until next time, keep building that thriving practice.